Your 401k just took its biggest single-day punch since January. The Dow dropped 268 points, wiping out a week's worth of post-election gains in a single session. But here's the kicker: while you were watching the S&P 500 slip, gold exploded to a record $5,054 an ounce, and oil surged 8% this month alone. If you think your portfolio is safe because AI stocks always bounce back, think again. The cracks in this market are widening, and if you're not paying attention, your retirement could be the next casualty. Let's break down what just happened, and why it matters to your money. First, the numbers. S&P 500 closed at 6,862, down 0.3%. Nasdaq? Down 0.3% as well, but it led the pack thanks to a last-minute rally in AI names after the Supreme Court struck down Trump-era tariffs. The Dow? It bled the most, closing at 49,395, down 0.5%. That's not just a red day, it's a warning shot. Why? Because the GDP data came in weaker than expected. The so-called AI productivity boom isn't saving Main Street as fast as Wall Street hoped. And while the Supreme Court's tariff decision gave tech a sugar rush, it wasn't enough to offset the disappointment. But here's where it gets dangerous for your portfolio. The real story isn't in stocks, it's in the bond market. The US 10-year Treasury yield just spiked to 4.096%. That's not a blip. That's bond vigilantes waking up, pricing in sticky inflation, and signaling that the Fed's next move might not be the rate cut everyone's betting on. And speaking of the Fed, Kevin Warsh was officially nominated as the next chair today. Trump's central casting pick is promising to cut rates and shrink the Fed's balance sheet, markets only giving an 8 to 18% chance of a cut at the next meeting. Translation: Wall Street doesn't buy the pivot narrative. Not yet. But the real danger isn't the stocks, it's what's happening in the bond market. We'll get to that in a second. Here's what the mainstream media won't tell you: smart money is quietly rotating out of risk. While retail investors are still chasing AI and tech, institutions are hedging with gold and oil. Gold just shattered $5,000 for the first time ever, as US-Iran tensions send shockwaves through commodities. Oil's up 8% this month, and that's not just about geopolitics, it's about a global scramble for real assets as the dollar weakens. Meanwhile, Bitcoin is showing its first real signs of decoupling from tech stocks. While the Nasdaq slipped, BTC climbed 0.7% to $66,919. That's a safe haven bid, not a meme rally. And the dollar index? Down 0.11% today, and 8% for the year. That's eroding the earnings power of every US multinational you own. If you're only watching the S&P, you're missing the institutional rotation, the liquidity wipeout that happens when bonds, commodities, and cryptos start moving in opposite directions. That's when retail gets left holding the bag. So, what's your Monday morning playbook? 1. Rebalance your risk. If you're overweight tech, consider trimming and adding exposure to commodities or short-duration bonds. 2. Watch the bond market, not just the Fed. Rising yields mean higher borrowing costs and lower stock multiples, don't get blindsided. 3. Hedge your dollar exposure. With the DXY sliding, look at international assets or gold to protect your purchasing power. Now, here's the debate: is the Fed lying about inflation, or is Wall Street just in denial? Drop your take in the comments, because the next move could make or break your portfolio. Don't just watch the market, outsmart it. Subscribe for tomorrow's Alpha ****.